Paul, what are we going to talk about tonight?
Breaking below the zero bound tonight. And I bet that just about everybody doesn't even know what that means. But I think it's pretty important that we have this discussion. I've got a small PowerPoint that I'm just going to work off of. And I hope that everybody enjoys this, because I certainly do. It's something we all need to consider, especially with the way things are going in our world. So recently, the Fed chairman, Powell, just had his latest meeting. Within that meeting, he made some statements, and it's kind of eye-opening. The zero bound, breaking below the zero bound, just pretty much equates to negative interest rates. And I talk about that a little bit in my book. And if you've read my book, you kind of understand what some of the consequences are. They really don't bode well for us unless we totally understand how that works. I can move through my PowerPoint. We'll see if we can't get this thing started. So in 1913, Woodrow Wilson started the Fed. And for those that don't know what the Fed is, it's an entity that creates all of our money in the United States. And it's part of the world banking system. It's just the one that we have in the United States. It's a privately owned company. Basically, it's not part of the federal government. And so they're the ones that create our money. And Woodrow Wilson was in charge at the time, around 1913. And as you see, he says, "I am a most unhappy man. I accidentally ruined my country." A great industrial nation is now controlled by its system of credit. Our government is no longer based on the freedom of opinion, nor on the conviction and the majority decision. It is now a government which is subjected to the conviction and the compulsion of a small group of dominant men. I mean, that statement is just huge. And I don't know if he really meant to say that, if he really was sincere, but what we're dealing with right now is a direct result of what he allowed to happen. And so there's a picture, the crime scene started in 1913. I thought that was kind of a fun little picture that I found. So what's the biggest problem in our world of money and finance? What is that problem? It looks like that. It's a mess. For most people, the world of money looks like that. They don't really understand it. They work hard. They give their money to somebody else to manage, invest, whatever you want to call it. They just hope for the best and not really planning for the worst. They have no idea what their world looks like, tomorrow, much less down the road. So how does the government control the use of our fiat dollars? Because all of our dollars are fiat money. And for those that don't know, haven't read the book, haven't been around, fiat dollars are really dollars, US dollars, that have no basis, in fact, for support. They're just, the government says this is the money we're going to use. There's no real support for it other than they make us use their money because they charge us taxes, and we can only pay our taxes with the US dollar. So therefore we have to use their money. So how does the government control the use of the fiat dollar? And really, it goes through inflation, deflation, taxes, and interest rates. Those are the three big things that we have to deal with in our life, in our financial life. So tonight, we're going to talk a little bit more about those through the new coming US dollar, and it's going to be digital money, but when it's going to happen, because it is coming, and it's coming like a freight train. And for those of you who don't know what digital money is, it's just money that's all online. There's no tangible money at all. And in fact, the Fed sounds like they are going to try to remove all of the M1 money. And the M1 money, for those of you who don't know, is all the money that you can feel, the currency, the dollars, the coins, and that kind of thing. So if all that's gone, and we're just now working with digital money, lots of things can change in our world. And I've been really taking a deep dive on this, and I just wanted to share this with you because it has many different consequences for each of us. There's some good, but there's a lot of bad stuff with this and within this whole concept, this idea. And let me just say that separating this from cryptocurrency, and that's a whole nother conversation, because this is not specifically a cryptocurrency dollar, but it will be convertible into cryptocurrency or anything else. With that, we've got the US government through the Treasury, through the Fed, creating money. And so that money is basically run, as I've said, in two different ways. It's either created where you can hold it, or it's created through fractional reserve. And now they're going into the digital side. And when you have the digital side, the government, and through Powell's conversation and through a paper or a new bill that's going through Congress right now, both in the Senate and the House, and it's supposed to be completed by the first of the year. It's all about digital money and how that's going to be implemented in our world. And it's coming really fast. And the best I can tell is that they can probably implement it within weeks of this bill being signed. And what does that mean to us? That means that the federal government through, well, actually not even the federal government, the Federal Reserve is going to be able to control our money, because they're going to, it seems like the plan is that the Federal Reserve is going to create wallets of money, so to speak, that we each have our own digital wallet that they can simply send money to outside of the US banking system. So they're kind of like separating us from the US banking system, creating individual digital wallets. They've kind of tried to do that within the last 90 to 120 days when they came out with the UBI. And if you don't know what UBI is, that's short for Universal Basic Income. Or it's basically just money created out of thin air that is allocated to whoever they want. In this case, it was, I think, sent to everybody who made less than $100,000. And it was money that was sent right to your bank account. Once the government, in this case, sent that money to the bank account, they had no way to know what happened to it. The federal government didn't, but they sent it out, trillions of dollars that they sent out. I'm not sure exactly how much, but then it was in the system. But there was a problem because they couldn't see what was going on. It was like their first real test at UBI, which is, just a whole nother conversation that we might have in future money talks. To overcome that with this digital money, they're going to create digital wallets for everybody. And so what they can do is they can just send money to each one of these digital wallets and control how we're going to spend it. Because as I said before, they sent all this UBI money out. They had no idea where it was going. So the velocity of that money was an unknown entity. And the velocity of money is basically how many times a dollar is turned over, right? When you spend it. And they saw a lot of that money from afar. It didn't really do anything. A lot of people just put it in their savings and didn't really spend it, so they couldn't really track where it was going. But with the digital dollar, they're going to be able to see everything. And in fact, the topic of tonight's conversation was breaking below the zero bound. So right now, the federal interest rate overall is right around zero. So what does that mean? It means that you finance your life and the interest rate is really low, not quite zero, because that's kind of what the banks are using between themselves. But for us, our interest rate is really, really low. And what they're talking about with the digital money is bringing the interest rate below zero. So you say, how does that affect me? Well, it goes like this. If the Fed has a direct link to your digital wallet, let's just say that they send more UBI out, more money to us for free. And they say, you've got to spend it. If we're talking breaking below the zero bound, there's a negative interest rate. What does that mean? That means that they're charging us interest to keep our money in their wallet. And if all of our monies from our jobs or whatever start being funneled into this digital wallet that the government is going to, or the Fed is going to oversee, then they can easily put timers on that money, for example. And that would say, you spend this money, the money that the Fed would give us to increase the velocity of money in the overall system, or you lose it, or you start losing percentages of it. And so what does that do to us overall with our money? We don't want to lose the money that's in there. So it's going to say, we've got to spend it or do something with it. And that's a problem, because it's going to increase the velocity of money, but it's going to also cause inflation. And for those of you who don't know what inflation is and or its opposite, deflation, those are huge things. And I talked about it a few minutes ago in some of the issues that we have with our money. So the more money that comes in to the system, the less valuable it is. And if we had less money in the system, the more valuable it is. And so the more money that they put in the system, the less valuable it is, and the higher the cost of products are going to be. Essentially, that's how we're going to see it. Their plan is to get rid of cash. And I just want to share with you how IBC fits into this, because it's kind of the perfect tool for this situation. So there's two kinds of values of money out there, as you see on the screen. You have intrinsic value of money and you have monetary values of money. And it's important to know the difference between the two. So intrinsic value that exists between an economic good, produces cash flow, or has an overt utility, like equities. That would be like the stock market, fixed income, real estate, consumable commodities like corn, oil, etc., and IBC, for all the reasons that IBC has. And then there's a monetary value that exists in spite of an economic good, not having intrinsic value, or a value that exists in excess of an economic good's intrinsic value, such as gold, silver, diamonds, artwork, US dollar, or IBC. What item within these two are in both? And the only thing that I could come up with was what? IBC, or the infinite banking concept, because it gives you both a monetary value and the intrinsic value. And so it allows you to have the ability for liquidity, and it allows you to have the ability to have uninterrupted compounding for life without ever destroying the yield curve that it has, which is, it just never goes negative. It's just the perfect setup for this new digital dollar that they're coming up with, and that we're all going to have to deal with in the coming months. That is going to affect us with the digital dollar. It's just that these are some of the key players that we need to understand, because if the government starts dumping money into these digital wallets that we're going to all get, and they put a timer on it, and they say you've got to spend it, where do you spend it other than, your day-to-day or month-to-month goods? If you're smart, you want to throw it in, to the stock market, for example, or maybe the infinite banking concept, which would be the smartest play here, because once you have it in your IBC policy, it's outside of their system, but it's inside a specifically designed life insurance contract, which is between you and the insurance company and nobody else. So you have full control over the liquidity. It's a great place to store your money. And then when you need it, you can simply just borrow out against the cash value, go use it without affecting the growth in it at all. And you have the death benefit just sitting out there, as a kind of a bonus. Without IBC, you're very limited on where you're going to put it, and the liquidity part of this whole thing, which is a pretty big deal, with inflation rearing its ugly head. And I think we're going to have a lot of it as soon as they start creating money and making all these digital wallets available for everybody. That's just going to pour even more money into the system. And if you have more fiat dollars in the system, you can't help but have inflation. And Powell was talking about, the Fed chairman was talking about trying to keep inflation right around the 2, maybe 3%. And that's typically what they've done in the past, is they try to target the inflation amount. Now what he said in that was that he's basically just going to try to target a window of a percent. So there's no real number that he's going to try to target on a day-to-day basis. He's just going to generally overall try to target a window of inflation with this new digital wallet. So really it's just another big experiment, like the fiat dollar was when they removed it off of the gold standard. And so bodes really well for IBC. So IBC, with the infinite banking concept, there is no government oversight. You have uninterrupted compounding of all your money. It's tax-free, all the growth in it. It has a yield curve that never inverts. You have full liquidity, all cash value. It has a guaranteed death benefit. It's a multi-generational design. It has no hidden fees or penalties within its system. And you can have as many of these as you want, which is kind of cool. You can move as much of your money in one of these as a foundational tool, and then use your money wherever you want, knowing that your cash value and the whole growth is never going to be compromised no matter how much you use it. In fact, the more you use it, the more you're going to save it. So you saw the piping system I had before, how convoluted it was. Well, this kind of represents what IBC looks like. Super simple. And those meters are really just in an IBC world, they're just the yield curve. It just constantly clicks up. And the more money you put in, the more money it's working with. And you have liquidity coming out the bottom as you need it. You just open the valve and use the money. And when you're done with it, you can just put it right back in the system. I mean, it's the most phenomenal tool ever. And so here's a picture of the yield curve, of a basic yield curve in an infant banking system. I have this in my book. So you can see over the years, the SDLIC or the IBC policy continues to grow year in and year out. And, for every dollar you start with, you see the red line. It's multiples of every dollar that will pay out instantly if you decided to graduate from the earth at any given time. And if you're fortunate enough to live to year 121, then both curves meet and they equal what the death benefit ends with. Beyond that, there's my book. I highly recommend you read it. Dave, do you have anything you'd like to share with us tonight?
Yeah, Paul, you mentioned about inflation. Okay, I'm going to go back. The first thing is the Fed. My knowledge of Fed history is limited. I can regurgitate some things, but why did Wilson feel he needed to initiate the Federal Reserve Bank?
Why did he feel? I think he was coerced into it. That's just my personal feeling. Do you have a thought?
It was because the bankers wanted to take the power of currency away from the federal government and bring it back into a private institution. Is that your understanding of that?
Well, it was probably a little deeper than that. Meaning, they saw a money grab that, when a small group of people if they create a dollar and they throw it in the system and they charge the system a percentage of that dollar on an annual basis, and they get that percent back every year from money that was created out of thin air. Why wouldn't you do that too?
So here, another question though, is you say we're at zero right now. We've been at zero for a long time.
Yep.
The Fed is always battling inflation. They're inflation. They're more scared of inflation than deflation.
Yeah.
We're for the last many years, we've been in more of a deflated economy. Would you agree?
When it comes to that, and that's a great point, I think we've got both of them going on right now at the same time.
Okay.
If you look at the equities market, for example, and what I mean is the stock market. Let's just look at the stock market.
Okay.
Is it going up or down?
As of yesterday, as of Friday, we're positive for 2020. The bear market of 2020 does not exist anymore because we are higher now than we were in January.
That's amazing. So if you deposit $1 and you buy a stock, for example, well, you have $1 of stock, and that stock goes to $10. Where did that $9 come from?
Yeah, it's fiat. It was made out of thin air.
Right. And so does that cause inflation? Is that an inflated dollar?
It is.
Absolutely it is. And so have the prices of food gone up? Has anybody on here seen the price of food go up? Yes. And that's because the value of your dollar is less. It can buy, it buys less. It buys less. So the cost is, we see the cost going up, but actually what's going on is the value of the dollar is going down.
Okay. So they're always fighting inflation.
Yep. And deflation on the other side goes like this. A great example would be this: technology. You see almost everything with technology.
60 TV for $199 now. It used to be $5,000.
Right.
Well,
but then you've got. This rabbit hole goes deep. Go ahead.
I'm going to go back full circle. This digital wallet that they're testing. You do believe that is a precursor for UBI, Universal Basic Income?
100%.
You think it's coming?
Well, it's already here. They already did it once.
Yeah, but I'm saying where, COVID proved it because everybody who wasn't working got $600 a week. Okay, I understand that. But then all that does though is you're right. If there's a time limit on when the dollars expire, like a library book, and you must spend them, that leads to almost a spending panic sometimes, doesn't it?
Well, absolutely. Where do you, if
But,
you were going to, if you
but
had money in it,
no, but wouldn't that almost be deflationary? Because if there's too many dollars out, well, no, you're right. I'm sorry, I did that exactly backwards, didn't I?
yeah,
If too many dollars chasing too few products, it's the price of the product's going to go up. If I have 4 potatoes and there's 100 people with each with $100 and each one wants a potato, my $1 potato isn't going to be $1 much longer. So,
no, right.
but it's
Yeah.
all. But here's the problem. It's all fake.
Well, it is. It is.
Yeah, dollars.
But that's what we've got going. And when they take the paper dollars out of the system and they only have this digital wallet going,
Yeah.
they control our financial world 100%, right?
Yep. Yeah.
So what do we do? What are the options with that dollar? If we have a digital wallet, we're going to either spend it or gamble it. Gamble it.
Consumer products, yes, and or put it back to work where we can get it working in an IBC policy
Yeah.
and take it back out and utilize it where we see necessary. That makes
Nope.
sense.
Nobody in their right mind is going to leave that money in that digital wallet for very long.
So then, but what you're talking about, and you and I talked about this a little bit, talked about this in the past, is that we are really truly devaluing money. I mean, money is going to become just a thing that is used as a transfer vehicle to acquire other things, and it will
Right.
have, it'll be 100% intrinsic value. There'll be actually no monetary value to it because it really won't be worth anything as an asset because it's a dwindling asset. It's like an option. It has a defined date when it will be worth zero. So
Right.
as you get closer and closer to that date, the dollar will be worth less and less until that last moment when it will just disappear. So
Yep.
it'll be a buying panic almost in at every expiration date. Whenever
Absolutely. So the velocity of money is going to just do this, right? It's going to constantly creep up.
So you're thinking it's just going to accentuate the cycle of booms and busts and make them even exponentially bigger and lower. We're going to have bigger booms, bigger busts.
Well, that's it. If you're an Austrian economist and you're following that trail of thought, I mean, yes. And so, there's an act that is associated with that bill that's both in the Senate and the House right now. Right now, it's in there. It's called the Banking for All Act. It's like it's coming like a freight train. So we're all going to be handcuffed. I was thinking today, it's like, shoot, the IRS is going to have their hands in that, and they'll just be able to pull the tax money out at their beck and call, or tell the Fed, look, this person owes in their digital wallet or whatever. Boom. Yeah. And then you put it's forcing you to put it into a commodity like gold or silver, which is an inflationary hedge, or some other item that I talked about earlier, or the stock market, where you're gambling 100% of your money in there because you have no idea what it looks like tomorrow.
Yep.
And or the net that catches everything would be the infinite banking concept, because once you run your money into it, it's out of the system and you have full control over it. 100%. It's like the only place that you have liquidity, 100% liquidity, without affecting the growth and a death benefit too. It has everything you want in it.
And then the whole idea there with infinite banking is the money is sitting there compounding. This sounds almost like a vulture. You're waiting for the busts when everything is repriced at the lower points to then take the dollars that you acquired during the booms and acquire income producing assets at the bust.
Absolutely.
And that's what the infinite banking system, and that's what we always talk about, is the vehicle. It's the vehicle where we take the money out of the fiat system, we put it into our own system, and we wait. And while we wait, it continues to grow.
And we don't even need to wait, but you can do that.
When I say that, though, I'm saying if we're at the top of a cycle, I'm going to use your digital wallet as an example. We're at the top of the cycle where we've got, and I'm assuming they're not going to have every digital wallet expire on the same day because that will cause panics. But we're seeing the ebb and flow, and we're at the top of an ebb, and we're about to flow down. And we see that there's opportunities where things are being repriced because we are coming into a bust, for lack of a better term.
Yeah.
And then we basically borrow the money out, acquire the assets. We know that they'll rise again. And right.
Yeah. You know, you look back at the market in March when it tanked. It dropped like almost 10,000 points, maybe 8 to 10,000 points. Why did it do that?
30%. Yeah.
Because people wanted to convert their shares of stock for what?
They wanted to change their intrinsic value to monetary value.
Yes. And I mean, right. But there wasn't enough money available to do the conversion.
Well, and a perfect example is what you see it in the real estate market all the time. And we're about to see it in the commercial real estate market because nobody's paying rent. Everybody's basically things that were top priced 16 months ago are going to be fire saled 5 months from now.
Yes.
Look at the real estate investment trusts that are in retail, they're all being just hammered, assuming they can stay in business. Their yields right now are insane. I mean, you're looking at 16, 18% yields in real estate investment trusts because nobody believes that what their properties are priced at is the true value, monetary value of that property. They're showing on their books as intrinsic value. Okay, so let's take another example that's going to apply to everything coming down the pipe. What we're looking at then is basically taking a population, and whether it be the United States or the world, and forcing them almost into poverty. Because if you don't do it exactly right, you're going to be buying high and selling low for the rest of your life.
You're under the finger of the Fed.
Not to be extreme, but it's almost like a new form of slavery.
100%.
That's just creepy.
And like Nelson said, he said, you got to think differently and you got to secede from this current system.
Yep.
Otherwise, you are screwed.
Yeah, it's seceding from the system while still living within the system that we all have to do. We all can't go and live in a year out in the middle of nowhere. So
we can't leave the matrix, but you can make it work for you, right? You can bend it, right, Dave?
We're gonna have to pretend we took the blue pill and live like we took the red pill. That's how it works. So
absolutely,
really absolutely. But yeah, it is interesting though because the Fed, on a public face of the Federal Reserve, they're always anti-inflation. So we've got these low interest rates going. We've got all this, but we see these little tweaks of inflation coming. The consumer price index, doesn't include food and energy anymore. That's priced out of it. So your food goes up, gas goes up or goes down, and it doesn't really affect the consumer price index.
Right.
But it affects the average American or the average citizen of the world's pocketbooks on how they actually, the money that comes in, now more goes out. It's already happening. They're just trying to digitize it. So it's like, people getting credit card debt. They ring up credit card bills because it doesn't seem like real money to them. And that's what they're trying to make it. It's disturbing is what it is. I don't know what we can do other than, go vote for a candidate that doesn't want this, but it seems like everybody wants it. Both sides want it because it's a way to maintain power.
Yep. And I was listening to somebody today, and they made a really good point for those people who follow gold. It's been on the move up. Same thing with silver and other precious metals, but most importantly, gold and silver. It's rising because the fiat dollar is crashing. It's losing its value, not crashing, losing its value. So really what you're seeing is the gold is gaining in price, but the buying power of the dollar is going down. And the bigger it gets, the further down the dollar goes. You're seeing the fiat dollar going the wrong direction.
I'm just going to take just a second and talk about this. There's, besides monetary policy, there's some other things that you can where you basically are getting inflation by fiat. If you follow the news, California passed a law called AB 5, which is the gig economy law. You've heard about
No,
it?
Go ahead and share.
It's a California law that requires firms to treat independent contractors and freelancers as employees. As far as laws go, it gets 0 stars from infinite bankers and people of any sort of common sense. But it is the California Assembly, and California is a perfect example of basically a centrally planned, centrally controlled economy with one political party, and there's no dissent. And so the goal was basically with the gig economy law was to give workers the dignity of a job instead of having to do gigs. But nearly all of them thought their jobs were undignified and making their own hours and directing their own destinies, which much more dignified than having the undignity of a job. benefits wasn't nice, but would be nice. But most people who are involved in the gig economy like the freedom of being their own boss and working as basically a 1099 contractor in whatever they decided to do. What happened is basically they changed the law that said, if you are doing what you are considered your gig for only one person or one entity, and it's the same job, you are now an employee. It was really directed at Uber and Lyft to make Uber and Lyft bring in all their drivers as employees. But what happened is it basically put musicians, artists, writers out of jobs. Thousands of people out of work, because they said basically if you're a freelance writer and you're writing for 7 different blogs and you're getting $30 an article for every one, but you're churning out work, but some of them are going to the Huff Post, some are going to the San Jose Mercury News or whatever else, you are an employee of those, and they have to make you an employee and start paying you benefits. Well, all these companies said, well, we're not accepting any more contractor work anymore. A bunch of musicians who did studio work are all out of work. So here's the problem is, right now, Uber and Lyft are suing California. It hasn't come to a resolution yet, but there's a bunch of people who are out of work from everything else that didn't include Uber and Lyft. Unfortunately, what you end up doing is if Uber and Lyft, are forced to comply with this law, they're going to have to raise their prices, probably much higher, where all of a sudden you have inflation. And basically what happens is a $20 ride becomes a $60 ride, which in turn doesn't become something that anybody can use, but becomes basically an unaffordable luxury to the bulk of the people that are using it. It's crazy. And those kind of things where people don't talk about it are these underlying things that make inflation without even planning you're making inflation. What ended up happening was a bunch of workers in the gig economy, not so much Uber and Lyft, but everybody else I talked about, writers, artists, musicians, temps, people who work from home, medical transcribers who do it independently, they packed up and moved. They all live in Reno or Boise now. I mean, it was a flood of independent workers out of the state of California. California, instead of saving them, ended up losing a bunch of tax revenue, and then also lost, basically an educated workforce that's now leaving, and their gig economy, and it's a mess. But what it did is it raised the prices of everything, and instead of saying, oh, I'm making widgets and you're my contractor that you do a certain thing of the widgets and I'm going to pay you X dollars for it as a contract, as 1099, they're like, I can't pay you anymore. I'm going to have to go with a contractor in Nevada, Idaho, Arizona, Utah, or somewhere else that doesn't have a gig economy. And right. I'm sorry. And they're like, you're out of work. And they're like, but I live here. I'm right down the street. And they're like, well, we can't afford to have you as a contractor.
Right.
The consequences. And that's where I'm going to come full circle here. What you're talking about is when you talked about these wallets, it's the same thing. I think what we're going to see is you're going to see a vicious circle that comes back, and it's going to have a lot of unintended consequences that's going to cause basically, depressions and bubbles that like we've never seen before.
Big swings.
Big swings.
And I keep coming back to IBC as as probably one of the best solutions, if not the best solution to this. Right. Because from here, you can deploy your money in anything, whether it's gold, silver, equities, the stock market. If you insist on going the 401k way, which is an absolute disaster in the making, you could even do that. I mean, but the idea is to run your money through the infinite banking system first, and especially in this digital wallet that's coming. I mean, you're going to want to get rid of your cash. And one thing I meant to say earlier too is this. I don't know anybody outside of my little circle that really understands what I'm about to say, but it's super important. Everybody already is in the zero bound area. What do I mean? If you have $1 in a savings account, in your checking account, you're already in a negative zone because you're fighting inflation, first of all. And right now, the official number is right around 2.5%. Okay. The way they calculate this inflation thing is beyond me, and it's certainly not accurate at all. So worst case scenario, if you have $1 and you keep it for a year and you don't spend it, you already have 98 cents next year. And if you did anything, increase the value of that dollar, it's going to be taxed on top of that negative inflationary rate, right? So you're fighting taxation and the inflation, which is a silent tax in its own. If you did nothing else currently and you just ran your money through an IBC system, you're already 3 or 4 basis points above that inflation taxable event. Not to even say anything about the uninterrupted compounding of the principal, interest, and dividends as you go forward in time for the rest of your life. I mean, Dave, what do I have wrong here?
You got it right. And on that note, we're going to talk about this more. Obviously, we have these discussions where it's meant to be more freewheeling. We will have more of these in the future. Quick note, we are recording this. I'm a little slow getting them up. Last one took me almost 2 weeks. It's been summer. I'll admit. I'm sorry about that, but I will probably have this one up on YouTube sometime in the next 4 or 5 days, and I'll send out an email that notifies it. We do have a YouTube channel. If you go to the Financial Prodigy on YouTube, you'll see all these going back to May when we started doing this. They're all on there, edited. You'll be amazed at how little we say and once it's on the YouTube video versus here. So anyway, as I mentioned earlier, if you want to check out our website, in the next few days, I'm going to throw up another page on the resources page that's basically got our reading list, where you can get Paul's book on Audible if you want. It'll have a direct link to it, but also other books we're reading, books that are from the Infinite Banking Institute, but also other stuff that we like to read, nerdy books about the economy or history books and things like that, but stuff that we like. I'll post the direct links to it. There's also a bunch of YouTube guys that Paul and I like to watch that, you could spend, not waste.
Thank you, Dave. Thank you. We're not wasting anybody's time here. We're educating so they're smarter, right?
You could go down some pretty deep rat holes on some of the YouTube guys we watch that all deal primarily with infinite banking and or the economy, but it's good education and a good basis for going forward in your own life. I'm going to get those up there. It'll be another resource page other than where our own videos are, and it'll be there under resources. You'll be able to see it. And
I just want everybody to implant in their mind, Dave. I don't mean to interrupt, but
no,
the piping system that I showed of all those pipes that were really messed up, I want you to cement that in your brain, because that's what you're looking at. And people work so hard for their money just to hand it off to somebody else in the hopes that they know what the heck they're doing, when in fact the infinite banking concept is so simple that anybody can do it. And you have everything in one vehicle that you ever need for a financial tool.
And here's the point of infinite banking, and this is where I learned it all along, because we all started out in that world where we put our money aside, and either we tried to manage it ourselves in the market, or we paid somebody to do it. There was a percentage, we'll manage your 401k. It's only 1% of assets a year. And all of a sudden, when you're down 10%, they still take their 1%. By putting it in an IBC policy, it gives you the time and the luxury of time to figure out what you want to do. You're not at the whim of the market, and you're not even at the whim of those conflicting voices that are telling you what you should do. You can say, wait a minute, I'm not ready for that. I think I'm going to just sit here and earn my interest and pay my premiums and save my money until I feel ready to do it on my own. And that's the big part of it, is the time constraint of I must get this done now out of it, so I'm going to hand it off to somebody because it has to be done right now. And that's the big part of it. And we can sit and we can watch the markets ebb and flow and inflation go up and down. And in the end, after you have your infinite banking policies in place, you know exactly what you're going to have every year going forward, and still have the ability to use it.
Yep.
I'm on
overcoming all the problems. Yep.
Okay. On that note, Paul.
Thank you, everybody.
Thank you for joining me, everybody.
Thanks for being here.
Yep. We're going to skip next week because it's Labor Day. And we're actually going to plan to skip a week rather than the usual Monday morning when Paul and I go, are we going to do this tonight or not?
All right, everybody. Thank you.
All right, thanks, everybody.
Have a great night.
Have a great night.
Hey.